This one is one of the ones that trips up so many investors, and it really trips you up when you are a new investor until you understand what a company looks like as it grows. When I first learned about the price to earnings ratio, I just applied it to everything. Everything was like, I couldn't understand why David Gardner was recommending so many stocks that had astronomically high PE ratios and getting them right. It was like, this company has a PE ratio of 400. I think it's a great buy. And like, that just did not compute in my head how that can be possible. But once you understand operating leverage and the phases of a business, you realize, or you come to learn when valuation metrics are useful and when they are useless. So there's a lot going on with this slide if you've never seen it before, but phase one of this just goes through the life cycle of a company. So phase one is R&D. There's no revenue coming in. The company is just all about the future. And there's no valuation metric that you can look at here to say this is a good one. You are literally betting on the founder. You're betting on the idea. You're betting on the management team. It's all hope. After that product is brought to market and launched, they're starting from revenue of zero. Because of that, the only metric that you can really look at them to judge their success is the price to sales ratio. Oftentimes, they are reinvesting so aggressively back into the business that their gross margin is low. Their expenses are ballooning as they scale to build out their commercial team, and their earnings are negative. Once they pass the launch phase and they prove out that they have nailed product market fit, that's when they cross over into break even. And that's a super confusing time for a lot of investors because it looks like their price to earnings ratio is in the hundreds or thousands of a number. And when you see that, you're like, well, this makes no sense. It's going to take them 1,400 years for me to get my money back on buying this company. But what I didn't realize at the time when I first was doing this was that the PE ratio is super high because the E is artificially low. The company is optimizing itself for profits, but it's not yet there. For example, if a company is eventually going to get to a 10% profit margin, so for every dollar in sales, they keep 10 cents, and they're currently at 0.5% profit margin, the PE ratio is artificially low by a factor of 20. If their PE ratio if their earnings yield is 0.5%, that's their current profit margin, and they eventually can get to 10%, that's a 20-fold increase. So because of that, their PE ratio is overstated by a factor of 20. That I didn't understand before, but as they continue to scale themselves, that's when you see operating leverage kick in and their profit margin expand. Once their margin profile is fully built out, they enter the mature phase. And from there, their earnings growth is no longer driven by operating leverage. It's driven by revenue growth, stock buybacks, and oftentimes small little changes to margin. At that stage, and only at that stage, is the price to earnings ratio usable. So the price to earnings ratio works great on Apple, on Microsoft, on Google, on companies that are fully optimized for profits. So don't use price to earnings ratio, which should be used in stage 4, on a company that's in stage 2. Because it will just throw you off and it will give you a false number. So this is something that kept me out of many great growth stocks at the time, even though they were highly recommended by people that I respected, simply because I said, PE ratio, too high. It makes no sense. Conversely, when you get into stage 5, when you are in a serial state of decline, don't get suckered into high dividend yield and low PE ratio. Because if earnings are heading towards 0, those numbers are irrelevant.
Oh, that's a great point, Brian. I love this chart. And figuring out where companies are is really important, and in thinking about them in your head, and where and how you want to invest.
Totally.